Maybe you have heard of this. Investing very easy, what? Just buy and hold S&P 500. You look at the last 10 years, 14-15% per annum return, correct? $1 becomes $3. 1 million becomes 3 million. Yes, S&P 500 has worked fantastically well, but today I may have some bad news. I'll share with you 3 reasons why moving forward, buying and holding just S&P 500 may not make sense. Hi guys, welcome back. Without further ado, let me dive on to the first reason, which is actually there's something not quite right with S&P 500 right now. It's actually kind of lopsided. I don't know if you realize some details of it. S&P 500 has been double-digit gains for 2025 at least. And if you think double-digit, which is 15% thereabouts, maybe 80 or 90% of all of S&P 500 are in green, correct? Logical what? But actually, that's wrong. If you look at it carefully, you realize the number of companies who are in the green right now are less than 55%. Almost half only leh. And we are not even a flat year. Let me show you some details. 271 of S&P 500 are in the gains right now. In the screenshot, you see Lockheed Martin, which is a king in defense. Booking.com, that one you probably know. Costco, if you've been to US. Chubb, a well-known insurer. Walt Disney. All of these big companies have done nothing in the year-to-date performance, and some even dragging down the index. Why is this so? The reason is quite simple. There are big outperformers tilting the overall S&P 500 performance. On the flip side, you'll see here the top performers, and long story short, they are more or less from the AI space. They are the ones pulling up many companies whose share prices are floundering right now. Top of the list, Palantir, Constellation Energy, AMD, CrowdStrike, and Google. Only Google has made it to the top 40, but they themselves have clocked 47% of gains. 47, that's 3 times more than S&P 500. And that's why nowadays, if you go and ask around, there are so many people beating S&P 500 in terms of returns. Wow, are we all geniuses if we beat S&P 500? Now the truth is revealed. In the near term, if you buy a popular name, especially something mentioned in social media like YouTube, it's actually fairly easy to beat S&P 500. But that, again, is in the short term. Let's look in terms of 10-20 years and we can see the investor's acumen, whether that is sharp or not. Actually, if you are from Singapore space, you map out S&P 500 against DBS, NCICT, and even Hang Seng, you realize that these would have been better investments over the last 1 year. Again, S&P 500 is not hard to beat in current climate. And maybe that's related to the next reason, which is S&P 500 is likely overvalued. The price-to-earnings ratio for S&P 500 right now is 30 times. If you know anything about earnings ratios, you realize this is a number that's usually quite high, correct? And that's why S&P 500 is one of the most expensive indexes if you compare across the world. Maybe you'll be thinking, S&P 500 has the best AI names, right? It has the highest growth. So price-earnings ratio doesn't tell a full story. We need to factor in growth, correct? So how can we do so? We can actually look at something called the forward price-earnings ratio, which forecasts next year's earnings. In this chart, you realize that it is still expensive at 25 times. Compare across, many markets are in the 15 to 20 times range. But again, forward earnings depends on the analyst's own forecast, correct? Is there a spectrum of forward earnings? Yes, there is. I'll pull up something else by JP Morgan, who has a slightly rosier forecast of S&P 500's earnings. They think it can grow earnings more next year. But even with their calculation, the forward earnings for S&P 500 is 23 times. And JP Morgan has actually published something quite gloomy. At forward earnings 23 times, this chart over here shows something. On the left is what happens after 1 year, and on the right is what happens after 5 years, when a stock index is priced at forward earnings 23 times. You realize that on the left, at forward earnings 23 times, there is still some chance of gain, but no more chances of more than 20% gain. Reason very simple. The higher the price you pay, the more it is priced to perfection, correct? The less there is for upside surprise. Get it? In fact, if we look in terms of risk reward, you realize there are far more lost years, with a few data points even with more than 20% losses, which means a bear market or at least a market crash. Why so again? The reason again is simple. The higher the price you pay, the more it is priced to perfection. And when any unexpected situation happens, that causes a failure to meet earnings targets, such as war, such as market share drop, such as profit taking, it will be the one hit hardest. Clear until here? Hopefully you've heard something different. Smash the like button. It's taken on team hours to prepare this presentation for you. And my main goal is not to seed panic. My main goal is to show you real data points and let you reduce your expectations moving forward, because I think that's very important. We are in a bull market for a while and it's very easy to get overly optimistic. Now let's move on to the right hand side. What we will realize after 5 years, buying now at forward price earnings ratio of 23 times after 5 years, there are almost no chances of gains. And the data point suggests that most likely it's a few percentage points of annualized losses. Not too good news, correct? How about 10 years? If you invest now, I hold for 10 years. Even with the 10-year data, again with forward price earnings ratio of 23 times, Howard Marks has this to say. When P ratio is 23 times, in every case, with no exceptions, your annualized returns over the next 10 years was between -2 and 2%. Quite sad, correct? Not worth your investment, correct? If market is rosy today, this will sound very ridiculous. But if market is crashing now, you kind of feel that possibility coming true. Again, I don't know when you're viewing this. Market mood might be very different. I'm just showing you when you buy expensive, it is hard to make money. And I have solutions, so stay tuned for it. Reason number 3 on not buying and holding S&P 500 only is this point. 4 double-digit gain years in S&P 500 is extremely rare. 2023, 2024, S&P 500 made more than 20% gains. And for this year, 2025, it's almost there already. It's also one of the reasons why S&P 500 has been overvalued. And if you look for data points, S&P 500 has achieved consecutive 2-year gains of more than 20% only once in history. That is during the late 1990s dot-com bull market, and we know what happened in year 2000. If we map up the data points, it's going to look very similar. More than 20% gains, more than 20% gains, and almost 20% gains in the 3rd year. What is going to happen in the 4th? Don't get me wrong, I'm not saying it's going to be a bear market like dot-com crash. I'm also not saying that the bubble is definitely going to burst. I have a crystal ball on it. Because if we look objectively, dot-com is also slightly different from this current bull market. Dot-com was a 5-year double-digit gain. We are, after all, in a 3-year double-digit gain at least. There's a saying, history may not be identical, but it rhymes. So what to do now, Josh? Maybe you'll be thinking of this. Sell? Run for the hills? Absolutely no. That is market timing 101. Then, sit on my hands and wait? Also no. So what to do? Let me present to you 2 very simple things that I'm practicing for my own private clients. The first is start building your dollar cost average. Start investing with it at least. Classic advice, but let me present data points to support it. I've presented to you the possibilities of a downturn, but the truth is no one knows for sure. If we look in terms of dot-com again, after 3 years of big gains, there are still 2 more big years. Could that also play out in 2026, 2027? We don't want to miss out on gains also, right? On the other hand, there could also be a small correction, a downturn. And if you start building your dollar cost averaging now, at least you're calm. At least you are confident. You don't need to second guess your own budgets. And it ensures also you do not miss the boat to buy at good valuations. I know there are findings that say that lump sum investing beats dollar cost averaging, but that only works in the up market when we look long enough. There are periods when one index underperforms for a long while, and things I'm presenting today suggest it could happen to S&P 500. Dollar cost average helps you survive in a down market. Don't die. Live to fight another day. And in choppy markets, dollar cost average wins hands down. Take a look at this chart over here. It teaches us 2 things. The first is that there are more up years than down, correct? Having some investments is still better than not having. The second is that every year, whether it's an up or down market, there seems to be always intra-year drops. Market corrections, small or big, no one knows. And that drop on average is 14%. Dollar cost average will have helped you massively, correct? That is why also I believe in it to build portfolios with, and that's what I'm doing also for my own private clients. Currently, I have more than 500,000 per month dollar cost averaging into the equity markets. I have a game plan for them. What to do, what should we react, these are things I value at. And as always, if you're looking for retirement planning and investment advisory, look for my links below. These are raving reviews from my own private clients. When the market downturns, that's where we're going to make money. Second tip I have for you today, diversify. S&P 500 has done very well. Many mainstream are suggesting just buy S&P 500. I'm suggesting do not just buy S&P 500. Move your monies to a few more places. Let me pull out a chart again to show you the performance across sectors. This chart maps out who's the best performer and who's the worst performer. Inside it, you'll see emerging markets, large cap, small cap, energy, cash, bonds, compared across years. So let's run through them. For this year, emerging markets 28% and developed markets 25%. Both have beaten large cap, which is a reflection of S&P 500. Personally for myself, I think emerging markets could do very well again in 2026 because they're coming off from such a low base. I also do feel that there's a chance that REITs could rank somewhere higher. If you look over here, last 4 years, REITs have been very bad, correct? Bottom half. Could they stage a rebound? I'm hopeful personally, but no one can guarantee it. So again, diversifying allows you to capture markets and ensure that your portfolio has better risk-adjusted returns. Hopefully, it can help you build better income for next year ahead. And thank you very much for watching right at the end. I have this to recommend to you, what to avoid when you do dollar cost averaging. Check out our tutorial and I'll see you there too. Take care as always. Goodbye.